Welcome to The Deep Dives, where we unpack the dense earnings calls and analyst notes so you don't have to. Today, we're jumping into a really interesting one. It's the Q3 2025 results for Ouster. That's ticker OUST. They're the digital lidar and physical AI company. The numbers dropped after the bell on November 4th.
Right. And our mission today is to really get into the core tension with a company like Ouster. I mean, on one hand, you have fantastic execution on revenue, real high growth. But the question is that enough? Is that scaling and the strong growth margins enough to overcome what are some, pretty serious investor concerns?
Concerns about what specifically? Profitability.
Profitability, absolutely. The aggressive R&D spend, and maybe the biggest one, the shareholder dilution that's been funding this whole operation.
So we're looking at a classic deep tech story, right? High growth, high volatility. They're betting big on grabbing market share now, even if it hurts the bottom line today. And the market, well, its reaction was pretty clear and pretty brutal. The stock dropped sharply right after the print.
It did.
So you need to know why, which numbers mattered and which ones, well, got ignored.
Okay, let's start with the hard data then. For the quarter ending September 30th, 2025, revenue came in at $39.5 million.
And how did that stack up against expectations?
It was a solid beat. I mean, roughly 7 to 8% above what the street was looking for. And that translates to 41% year-over-year growth. This is their 11th straight quarter of expansion, so the engine is definitely not sputtering. It's accelerating.
And it's not just about raising prices, it's about moving more product. The shipment numbers back that up, right?
Absolutely. They shipped a record something like 7,200 sensors in the quarter. So the demand is real. It's robust. A lot of it's being driven by their smart infrastructure vertical, which we can dig into in a bit.
Okay, so a great top line. But the problem starts as soon as you look a little further down the report.
That's it, exactly. The enthusiasm just, well, it evaporated.
So let's get into why. The bottom line numbers must tell a completely different story.
They really do. GAAP EPS was a loss of 37 cents. And when you compare that to the consensus, yeah, a lot of people saw that as a pretty significant earnings miss. The company's bringing in cash, but it's burning through it at a pace that I think surprised the market.
And the operational loss, the EBITDA, that confirms the spending profile.
Correct. Adjusted EBITDA loss was $10 million. Now, that was flat compared to last year, but it was $4 million worse than just last quarter, Q2. And that's the signal. Even with 41% revenue growth, the extra gross profit from those sales was just eaten up, and then some, by higher operating costs.
So that bigger than expected loss, sequentially, that's the red flag the market latched onto after hours. It seems like in this climate, a clear path to profit is way more important to investors than even 41% growth.
Mm-hmm. And to connect the dots here, we really need to look at the cost structure underneath all this, because the company's ability to make a profit on the actual hardware, that's improving a lot. Let's talk about gross margin, because that was a genuine bright spot.
Okay, how good are we talking?
Really good. GAAP gross margin hit 42%. That's up 400 basis points from last year. A big jump. And the non-GAAP number was even better. It was 47%. Management basically confirmed this is already at or even above their long-term target of 35 to 40%.
Wait, that raises a fascinating paradox. How can a company have nearly 50% non-GAAP gross margins and still post a $10 million adjusted loss? That feels intentional.
It is absolutely intentional. And what this means for you listening is that Ouster has basically solved the hardware margin problem. They've proved they can build this stuff at scale and make a healthy profit on each unit. And that success, well, it gives them the permission to run these huge net losses by pouring all that cash back into future growth.
So the loss isn't from sloppy manufacturing. It's a strategic choice on where to spend the money.
Precisely. The GAAP net loss did get better year over year. It shrank to about $21.7 million. But that was mostly from the higher gross profit and, this is a key detail, getting rid of their old debt interest. They actually had interest income this quarter, about $2.4 million. The real burn comes from OPEX operating expenditure, $40.9 million, up about 7% year over year.
And where's the bulk of that $40.9 million going?
It's almost all going into one bucket, R&D, research and development. About $17.8 million of that OPEX was just R&D, funneled directly into their next generation of products. Management sees this as non-negotiable, even if it crushes the EPS number in the short term.
Okay, so let's unpack the capital strategy that allows them to make this big bet. It created this huge war chest of cash, but it came at a pretty steep price for shareholders.
This is the absolute core of the investor conflict. Ouster now has a ton of liquidity, cash equivalents, short-term investments. It totaled a massive $247 million at the end of the quarter.
Wow. And what was that number before?
To give you some perspective, it was only about $48 million at the end of 2024, a huge increase. They also have zero debt now. So they're saying this is enough runway for at least the next 12 months, probably more.
That $247 million is definitely reassuring. But it didn't just appear from profits. It came from their at-the-market, the ATM equity program.
Correct. The company raised about $94 million net from that ATM program this year. And while that created the war chest and wiped out the debt, which are good things, it significantly diluted every single existing shareholder. Shares outstanding ballooned to about 60 million from around 49.5 million just a year ago.
That's a huge jump. Over 20% more shares out there. So you have to ask, doesn't raising $94 million through dilution send a signal that maybe management isn't confident they can get to profitability on their own?
That is the exact concern that tanked the stock post-earnings. Management's view, though, is that this is strategic de-risking. They see this massive, multi-billion-dollar future, especially with the new L4 chip, and they want to guarantee they have the capital to see it through, no matter what the markets do. They chose a long-term execution runway over short-term EPS pain.
Which only makes sense if the strategy is going to pay off that dilution. So let's pivot to that. The Q3 growth came from this physical AI thesis. What does that actually mean for Ouster, and where are they getting traction?
For Ouster, physical AI is all about using their lidar sensors to feed data into AI model, which then make decisions in the real world. And Q3 growth really came from two places. Smart infrastructure, so things like traffic monitoring, logistics yards, retail analytics, and industrial robotics like warehouse automation. So they're not just waiting on the slow-moving auto sector.
And this is where the software comes in, right? Making the hardware sticky and creating recurring revenue.
Absolutely. Management is all in on driving higher software attach rates. They don't just want to sell you a sensor. They want to layer on their analytics and perception software. That's what locks customers in.
Can you give us a concrete example of that?
Yeah, they give two good ones. Their Gemini solution is being used for crowd management in South Korea. But the real star was the Ouster Blue City solution for intelligent intersections. Management said that Blue City has a 100% attach rate for its software.
A 100% attach rate. That's huge. Why is that so important?
It means every single time they sell the hardware, they are instantly creating a recurring high-margin software business on top of it. It completely changes the customer lifetime value. If your entire traffic system runs on Ouster's software, you're not going to just rip it out for a slightly cheaper sensor down the road. It's defensible.
So software is one part of the growth story. The other is the product itself, which is where all that R&D spending is going, the L4 chip.
Right, and this is where it gets really interesting for the long term. The R&D is laser focused on this next-gen L4 lidar chip and their Chronos custom silicon. They call it their most profound investment to date, and I think they're right.
What's the big leap forward here? What does it do?
The L4 is designed to do two things at once. Radically boost performance, we're talking range and resolution, while at the same time slashing the manufacturing cost. And management believes this lead could more than double their total addressable market, their TAM. It's about making their product both cheaper and better.
We hear a lot about pilot programs in this space, but the real money is made when those pilots actually scale up. Did they give any proof that customers are moving from just testing to full-on commercial deployment?
They did, and it's really the heart of the long-term bull case. They pointed to Serve Robotics as a perfect example. A year ago, that customer had about 57 active robots. By the end of this year, they're on track for 2,000. I mean, that is a real order of magnitude ramp up.
That's a great example, but is that happening across their customer base?
This is the key. This is the big untapped catalyst. Management said that out of their more than 1,000 customers, less than 10% have reached full-scale production. So that 41% growth we're seeing now, that's just the trickle. The real flood of revenue comes if and when the other 90% convert.
So given all that, what's the guidance for the immediate future? What do they say about Q4?
For Q4, they guided revenue to between $39.5 million and $42.5 million. So at the high end, you're looking at continued growth and still maintaining that 30+% year-over-year expansion. The growth story is still very much intact.
And what about profitability? No explicit EBITDA guidance, but what's the long-term plan?
The framework is still the same. Keep growing revenue 30 to 50% a year. Keep those gross margins in the 35 to 40% range. The goal is to eventually hit positive adjusted EBITDA once they achieve massive scale and that intense R&D spend on the L4 chip starts to level off.
And on those really big future markets like humanoids or fully autonomous cars, where do they see themselves right now?
The CEO used a great baseball metaphor. He was really candid. He said, for those huge markets, we're still in the dugout. we're not even playing the game yet, which just highlights how small their current revenue is compared to the massive potential they're investing all this money to go after.
Which brings us back to the sector. Ouster is trying to be one of the last big U.S. lidar companies left standing. And their execution, looks a lot cleaner than some of their peers.
For sure. They definitely seem more scaled and efficient than, say, a competitor like Luminar, which has seen its stock get hammered over the last year. Ouster is actually proving it can grow fast and maintain those high margins.
Right. But that story was put to the test this quarter. And the stock had already pulled back a lot before the call, so expectations were already coming down.
And that's the trade-off investors are struggling with. It's simple, but it's causing this conflict. You've got the $247 million safety net and the 40+% growth. You weigh that against the ongoing losses and the constant threat of more dilution from the ATM. And this quarter, fear won.
So the company's doing what it said it would do, grow, improve margins, invest, but the market just slammed them for the short-term EPS hit.
Exactly. For the market to come around, it's going to need to see a much clearer timeline for that L4 chip and more proof that those other 90% of customers are ready to start buying in bulk.
Okay, that brings us to our This Is Not Financial Advice segment. Given all this volatility and these long tech cycles, what's an outrageous but plausible trade idea here?
Well, the thesis really builds on everything we've talked about. The market is hyper-focused on punishing the short-term dilution and EPS loss, but the engine is running hot 41% growth, 47% non-GAAP margin, and that $247 million in cash takes immediate bankruptcy risk off the table. It gives them the time they need.
So how do you play that long-term potential, the L4 chip and the customer ramp, while trying to sidestep the immediate pain from dilution?
The outrageous but plausible pitch is to look at buying long-dated, deep-in-the-money call options, expiring maybe 18 to 24 months from now. It's a capital-efficient way to get exposure to the massive potential upside if the L4 chip is a hit and those customers convert, but you don't have to put up all the capital to buy the stock today.
And how does that specifically help with the dilution risk? That's the key, right?
It is. By using long-dated calls, you're aligning your bet with management's multi-year timeline for the L4 cycle. And, crucially, you insulate yourself from the day-to-day noise of the ATM. If Ouster sells more stock tomorrow and the share price drops, a standard stock position takes a direct hit. Your call option is less sensitive to that immediate move. You're basically making a pure bet on the long-term execution of the company and betting against the short-term negative sentiment that's crushing the stock right now.
A strategy to bypass the short-term noise and bet squarely on the 2-year roadmap.
Interesting.
Okay, so a quick recap of the key takeaways from Ouster's Q3 call. The strong growth and incredible 47% margins. They validated the long-term thesis, record sensor shipments. But the heavy R&D spend and that $94 million ATM raise meant profitability is still way out on the horizon, and that's what triggered the market reset.
Which leaves us with the final provocative question for you to think about. Management is committed to this heavy investment in the L4 chip, which they say will double their market opportunity. So at what point does the market stop punishing the immediate EPS loss and finally start rewarding the huge long-term growth opportunity that the CEO admits they are still in the dugout preparing for? That is the tension they have to resolve.